What is market leadership actually worth today? That is the question at the center of PhonePe's upcoming IPO. On the 21st of January, PhonePe made its draft papers public. Now, this is a company that most people already use, often without even thinking about it. It processes more UPI transactions than any other app in the country, and it has held that position for years. Even so, the timing of this IPO makes it rather complicated. You see, PhonePe is coming to the market after a long and eventful period for India's fintech sector. 4 years ago, Paytm went public, and that listing shaped how investors look at payment companies, especially around valuation and profitability. Ever since, Paytm's stock has seen sharp swings, and its public market journey has influenced expectations for the entire sector. So, PhonePe is going to be entering the public markets with that history already in place. And it does that as the market leader in transactions, but it is still loss making. Many revenue streams that supported margins are either under pressure or have already ended. At the same time, the company is expected to seek a valuation higher than Paytm's current market value. And that makes this IPO more than just a routine listing. It becomes a test of how investors price leadership in a business where profits have become difficult to sustain. It also raises the question of whether PhonePe will be seen independently or largely through the lens of Paytm's experience. Welcome to Daybreak, a business podcast from the Ken. I'm your host Nigda Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Today is Tuesday, the 10th of February. PhonePe is looking to raise around $1.3 billion through its IPO. The entire issue is structured as an offer for sale, which means no new capital will flow into the company. Some early investors are exiting completely. Tiger Global and Microsoft are selling their stakes in full. Walmart, meanwhile, which has invested about $700 million in PhonePe and owns about roughly 72% of the company, is selling about 9% of its holding. After the listing, public shareholders will own around 10% of the company. PhonePe is a decade old and has consistently led India's UPI ecosystem. It processes the highest number of transactions in a market with more than 80 payment apps, and its market share is close to 49%. Despite that position, PhonePe is listing later than several of its peers. Paytm went public 4 years ago, and other consumer internet companies also listed earlier in their life cycles. That timing matters because Paytm's listing still anchors investors' expectations. Paytm went public at a valuation of about $20 billion. Today, its market cap is around $7.9 billion, and the stock trades roughly 40% below its issue price. Over the years, its valuation has moved sharply in both directions. But here's the thing, on financials, Paytm has recently edged ahead. To understand what is going on better, we need to look closely at PhonePe's path to listing. It involved a significant structural change. In 2023, Walmart paid nearly $1 billion in taxes to move PhonePe's domicile from Singapore back to India, which was a requirement for listing locally. And that cost has raised expectations around the valuation. The company's last fundraise, which was in 2023, valued it at $12 billion. Bankers now expect the IPO valuation to fall between $12 to $15 billion. At that level, PhonePe would list at a meaningful premium to Paytm's current market cap. But some investors compare it to Paytm's IPO valuation rather than its present value. And others see Paytm's post-listing performance as a more relevant benchmark. The market's response is ultimately going to indicate which view carries more weight. More on this in the next segment. At a business level, PhonePe and Paytm share many similarities. Both earn fees from consumers, merchants, and banks. Both receive government incentives tied to digital payments adoption. And both operate in a payments business where margins are thin. And because of this, both companies have focused on expanding beyond payments. They use their large user and merchant base to distribute financial products such as loans, mutual funds, and insurance. These products offer strong economics than payments alone. The difference between the two companies, though, appears in the revenue mix. I'll be bringing up a bunch of numbers now, so do pay extra attention. In the half year that ended in September, more than 80% of PhonePe's operating revenue came from payments. For Paytm, on the other hand, payments accounted for only about 55%. Nearly 30% of Paytm's revenue came from distributing financial products, while for PhonePe, that contribution was only 13%. Paytm began distributing consumer loans in 2017 and expanded to merchants soon after. PhonePe started distributing merchant loans only in 2023, and neither company lends directly. Operational focus also differs. Paytm has around 45,000 people working directly with merchants, roughly twice of PhonePe's on-ground strength. Over time, Paytm leaned more towards merchants, while PhonePe focused more on consumers. But there is still room to grow. Paytm has 45 million merchants, but only about 650,000 have taken loans, while around half returning as repeat borrowers. PhonePe, meanwhile, has over 600 million registered users and 47 million merchants, though it did not disclose financial product penetration in its IPO papers. At the same time, user overlap across platforms has increased. Payments apps, telecom apps, and credit marketplaces often serve the same customers, limiting incremental growth opportunities. PhonePe is also facing near term revenue pressure. In January, reports suggested that a government incentive for payment infrastructure may have ended in December 2025. And that news caused a sharp drop in Paytm stock. For PhonePe, incentives contributed to about 167 crore rupees in revenue in the 6 months that ended in September. These revenues involved minimal additional costs. Other revenue streams have already ended. PhonePe stopped processing rent payments via credit cards after receiving a letter from the RBI. That feature accounted for about 18% of its FY25 operating revenue. The Supreme Court ban on real money gaming has also reduced revenue by another 3.5%. And profitability reflects these developments. Paytm turned profitable in mid 2025 and reported 144 crore rupees in profit for the 6 months that ended in September. PhonePe, meanwhile, reported a loss of 1,444 crore rupees during the same period. PhonePe does have its strengths while going into the IPO. Walmart's backing itself carries weight with investors. The company has maintained a clean governance record as compared to Paytm. It also had about 6,300 crore rupees in cash at the end of FY 2025. But public markets have changed. IPO valuations often differ from post-listing performance, and many companies now trade below their issue price. And this puts added focus on the story that PhonePe is going to present to its investors. To justify a premium, it will need to show how leadership in payments can translate into stable profitability over time.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.